Good afternoon and welcome to the CHECKIT PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Kit Kite, CEO. Good afternoon to you, sir.
Hey, good afternoon. Thanks. And thanks everybody for joining today. It's both good afternoon and good morning. I'm actually doing this from the United States on the East Coast. And so for those who are joining from the US, good morning as well. Okay, good. So we'll get straight into this. Very pleased to present the highlights, trading update highlights for the financial year 2024. And pleased with the 16% growth in ARR to £13.3 million. Also, recurring revenues are now at 93% of our total revenue base. So this is really powerful from our perspective and in line with our strategy, helping us better predict future revenue streams and income streams that come through. And as Greg will take you into a little bit more detail, we've also halved losses for the year in line with our strategic imperative to expedite path to profitability. So again, very pleased with that result. Our land and expand strategy as it relates to customer growth continues to be validated. We signposted an MSA that we signed with Compass Group at about the half-year point last year. Since that point, we've added 5 new contracts with that particular customer, and the pipeline of further opportunities continues to grow as we look at the year ahead. So again, very exciting. And as it relates to our product, and we'll spend a bit of time talking about this as we go through the presentation, we continue to invest in making a scalable single platform, but more importantly, investing in what we do with data, customer data, and how we harness the power of AI. All right, so we'll just cover off how we're going to spend this session. For those that are new, and as a refresh for those that have been with us for a bit, we'll cover off who we are and what we do, what makes CHECKIT differentiated in the market. I'll then cover off our strategy before doing a review of FY24, and then hand over to Greg for financials before we open up for questions. Okay, so effectively, who is CHECKIT? What is CHECKIT for those that are new to this story? We play and we target large blue chip multi-site enterprises that are specifically focused around the deskless worker. Okay, so large enterprises for whom the majority of their workers do not sit behind a desk. They're interacting on the shop floor, in the warehouse, with machines, with customers from food retail operations, healthcare companies, biotech companies, people working in labs. These types of workers, people who have to move around and interact with the built environment. And our target is to optimize and help businesses make the most of these workers, these assets, in order to be far more operationally effective. So they can sell more, they can run their business more effectively. So if we look at a cascading stack here from the very top, what we're doing is we're helping senior executives, operational leaders, heads of compliance, heads of maintenance. We're helping them by making visible the state of their operation. These are large organizations who are typically operating in the dark. They don't have data. They're not able to track the work that their people are doing. They have no visibility of how their assets are working. We make that visible through the CHECKIT platform. Okay. In the hands of a worker, what this looks like, it looks like an iOS app or an Android app or a tablet or a memo device in their hands. That is the CHECKIT workflow tool. And that guides, prioritizes, assists the way they interact with the environment, the tasks they need to do, the daily checks they need to do, their ability to capture photos, their ability to signpost faults in real time to better improve the operational performance of the business. Surrounding the worker is typically a built environment. Okay, they could be very complicated healthcare systems and assets like deep freeze fridges and freezers, vaccine storage units. They could be hot holds. They could be any number of physical assets. And our IoT, Internet of Things sensor network allows them to be continuously monitored, automatically monitored thus removing the need for humans to have to interact with their assets and feeding those alerts and those data points back into the platform to create a continuous ecosystem. And then the final point here about what makes CHECKIT quite exciting is if you think about the environment in which we're operating, you're taking customers from an analog world, one where they rarely get any data at all, literally using pen and paper or Excel spreadsheets, to a digital world. So we're generating vast amounts of data. And as we go through the presentation, I'll explain how we're bringing that data to life in order to mine and provide intelligence for operational leaders to further drive cost savings, sustainability initiatives, etc. Okay, so let's have a quick look at the strategy then that we're pursuing. As I mentioned, for us, we operate on a pure SaaS recurring revenue subscription model. It's now 93% of all of our revenues. So we've continued a transformation on that path. Minimum 3-year terms that we sign with customers, very high net revenue retention rate, as Greg will take you through. The non-recurring revenue that we do sell is effectively professional services, configuration, platform optimization, and training that surrounds an implementation of the CHECKIT platform. The second key pillar, one of the reasons why I'm speaking to you from the US at the moment, is that we want to continue to leverage our success, but more importantly, expedite it into the US market. We need to make the US a success. The US we see as a significant growth opportunity for CHECKIT, given the size of the customer base, the type of blue chip customers, and their match with our CHECKIT, with our platform and our product. And the third piece is we're continually looking to refine both the markets and the industry verticals in which we play in order to find the right fit between our product and the margin that the customer has, such that when they have product outages or stock wastages, it becomes a critical pain for them. We see a lot of opportunity, particularly in the US. So let's take a step back and just consider how the platform and the ecosystem actually works. So we have a workflow tool that is the core of our platform. Okay, effectively, we're helping workers and customers do 3 things. Okay, we're helping them manage the workforce, manage the operation through the use of dashboarding, insights, and analytics generated by the tools that are in workers' hands. So visibility and optimization. At the same time, we're able to integrate both data and information from a live environment, asset performance, environmental data back into the platform to further assist the performance of the operation, but also the visibility of what else is going on in the environment. And in the hands of the worker, we're helping not just to assist them to get the job done, but we're transforming the way they interact in their workplace. And we should remember that in these industries, we're typically dealing with 75 to 80% attrition rates amongst the workforce. And this leads typically to a situation of knowledge walking out of the door. So anything that we can do to retain knowledge, onboard workers much more efficiently, and indeed retain workers because they're equipped with the kind of tools that they expect in their daily lives, becomes a real benefit to an organization. As I mentioned before, what we've got here is an IoT and sensor network that then sits around that platform. It's like an ecosystem. Okay, and it is used to monitor the assets that exist in their built environment. So as we said, fridges, freezers, vacuum storage units, HVAC controls, energy management systems. These sensors are reporting and alerting in real time the monitoring of those assets back into the platform so that leaders and people on the ground get immediate visibility as to when there's an issue in which they can then take a remediation action. This is very, very powerful. I mean, only last week, there was an article in the Guardian newspaper that talked about a Swedish research laboratory who had lost, over Christmas, had a freezer failure. That failure cost them decades of research samples to the tune of £37 million. That's just one asset going down. So you can see the value of being able to monitor this automatically and then immediately act upon it if there's an issue using a human. Taken together, you get a single end-to-end platform that drives intelligence. And this really is the core of the CHECKIT value proposition. I think it's what makes us stand out amongst peers and competitors. We not only monitor the assets, but we also digitize the people. We bring them together seamlessly. So you get this playoff effect between assets, people, actions, remediation actions, inspections, etc. But more importantly, as we'll see, we generate a lot of data, and that data becomes very, very action-oriented and becomes intelligence for the senior customer. So what are we actually doing then with the data? What's really exciting about this? Over the last 6 to 9 months, we came to a realization that we were sitting on vast quantities of data, billions of data points being generated across our customer base. And with the advent of large language models and the usability of AI inside the awareness and consciousness of senior customers, we decided to get ahead of the market or ahead of the curve on this, and we started to turn the data sets that we're using into actual reusable information for customers. So not just turning into information, but into action. So we've built machine learning and AI algorithm tools to help drive, in particular, sustainability initiatives for customers. What does that really mean? What it means is, by monitoring their assets in real time and generating the data from them, we're able to give customers predictive maintenance benefits. We can tell them when an asset's likely to fail before it fails, thus preventing the kind of incident I described earlier from the Swedish research laboratory. That in itself is highly valuable. But not only that, we're also able to predict the asset health as a whole for customers. So for example, when and how do you do swap out routines of your assets? At the moment, when you're flying blind, maintenance leaders are just replacing assets en masse, again, at huge cost and inefficiency. On top of that, and especially given the energy fluctuations we've seen over the last year or two since the Ukraine crisis, our ability to also help customers manage the optimal performance of their assets within the correct temperature ranges, again, yields a per unit energy saving that, when you put that at the scale of thousands and tens of thousands of assets, becomes significant for an organization. We have these algorithms built. We have them in beta with one of our largest customers in the UK. And what's really exciting is the opportunity to then roll that out over the course of this year across our existing customer base, and indeed as a point of difference for new customers. Okay, so let's take a look at the year in review. Again, I've mentioned our focus on recurring revenues. I think that point has landed. To say here that we've been growing our recurring revenues at a compound annual growth rate of 30%. And really what we see now is a really tight linkage between the ARR that we bring in and then the recurring revenue that flows from the following year, as you can see in FY24, following on from FY23's ARR growth. The US is a critical global market for us. We've been in the US for about 3 years. It is now worth about 26% of total group ARR. And this is a really positive first step. But as we know, the US market is not just significant, it's highly competitive. So for us, it continues to be a focus for growth. Some of the aspirations I've put on the US team and the US organization is for it to be the leading contributor of ARR to the business within 2 years, and the leading overall contributor of ARR within 2 to 4 years. Okay, so big goals for the US, but we see this as really where we can make this business grow the most. And then before I move on to financials with Greg, I just want to elaborate on the markets we play in and the future markets we expect to be in. So again, for those who are new, our ARR is roughly split 30% from healthcare customers. So think the NHS, we're in 86 different trusts, private hospitals, blood plasma providers, even a few pharmaceutical providers, retail, which would encompass food retail operations, the likes of BP or John Lewis Waitrose that we've spoken to before, and indeed hospitality. So hospitality would also include what we call soft FM, so the likes of Compass Group and Sodexo, who are customers, but also very large and well-known hotel providers. And it's roughly 30% in each category. What we see next, alongside the product innovations, is where we will target future markets. So for us, adjacent industries such as food manufacturing become the next best low-hanging fruit for us to target. Why? Because we have the domain knowledge, but also they have the product quantity and the margin risk that comes with stock loss, inefficiency, and poorly run operations. And same again with biotech and R&D laboratories, as I signposted earlier. So this is a very exciting opportunity for us to expand.
Right, I'll now take over and talk about the financials. When it comes to the financials, I talked about two key themes this year. So those themes are growth and efficiency. And I'll update you now on the progress we're making on both these fronts. So first of all, growth. And today we report annual recurring revenue growth of 16% year on year, recurring revenue growth of 17%, and total group revenue of £12 million is also grown by 17%. When it comes to efficiency, we've been able to deliver a 46% improvement year on year in our EBITDA from 6.4 million to 3.4 million. And with cash of £9 million at the year end, we're very confident in our runway to break even. So if I go into the top line growth in a bit more detail. So as I said before, ARR grew by 16% from £11.5 million to £13.3 million. And revenue grew by 17% from 10.3 to £12 million. And both of these are in line with analyst guidance from Singers and Edison, despite the challenging economic conditions everyone has faced. Our land and expand strategy to bring in customers on a smaller initial sale, show them the value we can offer, and then upsell and cross-sell has generated growth from our existing customer base, which is evidenced by a continuing high net revenue retention rate of 111%. And our gross revenue retention rate of 99% further evidences the stickiness of our customer base. With 93% of our revenues being recurring, this provides good visibility for future periods. So just to explain that a bit more, on this slide, you can see ARR of £11.5 million in FY23, and that provides visibility for FY24 recurring revenue of £11.2 million. And we expect that trend to continue. So our strong recurring revenues give us a solid base, which allows us to pursue our path to profitability. And on this slide, we can see how we've been able to grow revenue while reducing our EBITDA losses. EBITDA of £3.4 million is an improvement of 46% from the £6.4 million we reported last year, so nearly half the amount. We've achieved this in three ways. First of all, by improving our gross margins, by carefully managing our operating costs, and also by delivering operational efficiencies. And to give a specific example, we moved our first line customer support offshore in September. As well as delivering some cost savings, that's leading to an improvement in the quality of service that we provide to our customers. And I'll talk more about our cost management program when we present our full year results in April. But for now, I'll hand back to Kit.
Yeah, thanks, Greg. So that concludes our presentation for now. I'd like to hand over to Alex, who will field some questions that have been posted in.
Thank you, Kit. Yes, we've had quite a few questions that have come in. Some are quite similar to each other, so I'll try and group those together. But the first one I'm going to kick off with is on the land and expand strategy. And the question is, what is the split of ARR growth between this and simply putting up prices for existing customers? So I guess maybe you could give a breakdown between price and volume on that.
Yeah, thanks. I mean, ultimately, the split between new or existing customers and price growth is around about the 70% existing customer expansion, 30% price growth. We had been quite successful with price growth in the previous couple of years, but we feel we've hit saturation point with existing customers there. Therefore, it's about upsell and cross-sell of new sites and new locations.
Thank you. We've had a couple of questions in on this. One came in ahead of time and one came in during the call, which is on new customer numbers. Management have talked about a significant opportunity pipeline. Could you comment on that and talk about how many new customers have been acquired over the last year?
Yeah, so we'll be able to provide new customer numbers when we present the prelims in April. But again, in line with the land and expand strategy, what we do see is that the cost of acquisition for new customers in the current environment is quite expensive and protracted. So where we do get them, for example, Macy's in the US recently, we then expect to expand from there. So typically new customer acquisitions are lower in contract size, hence the land, and then larger as we expand them out over time.
Thank you. Next question is on gross margins. With the recurring revenue percentage of total revenue at 93% for both FY23 and FY24, are further gross profit margin expansion possible from the high 60% level at July 23?
Yeah, so let me answer that one, Alex. So we had, just as a reminder for everybody, at the last year end, we had gross margins of 63%. Those increased to the high 60s at the half year. I'd expect this year end that would continue to be at the high 60s, that same sort of level. And then next year, I do expect there to be further gross margin expansion to be starting with a 7. So yes, is the short answer.
Okay, thank you. And then a specific question on contracts. How big is the average contract size, and what is the largest individual customer?
Yeah, so as I mentioned earlier on land and expand, average contract size is in a region of about 20 to 25,000 pounds of ARR. This is quite typical for industry peers such as ourselves. In terms of the largest overall customer, that would be Waitrose John Lewis, which is just over 2 million pounds of ARR. Okay, I might add further. I mean, there's a sort of follow-up question to this. You know, in terms of the ARR profile, we've got 500 customers, but the top 10 customers represent about 35-40% of our ARR, but top 20 is about 55 to 60%, and then there's a longer tail beneath that. Again, thinking about the focus of where we're growing the business, it's increasing the size and the number of those larger blue chip customers, which do come with longer sales cycles, but that's where we see, you know, the bigger value over time.
Thank you. Next question. How should we view selling and distribution costs in a higher inflation business environment? For example, how much ARR or lifetime revenue can be expected to be generated per £1 of sales and marketing costs?
Yeah, I'll let Greg just handle that conversation.
Yeah, sure. So it will vary by area. So certainly we look at the CAC that we have to incur, and that will be higher for enterprise customers, and it will vary between the food retail side and the medical monitoring that we offer to customers. So I think there's no real straightforward way to answer that directly, but I would say that in terms of sales and marketing, we certainly are seeing progress in terms of how we're developing the way that we sell into customers.
Okay, thank you. I'm going to group another 2 questions together. What do you forecast as the minimum cash balance before you break even? And then is there any risk that you need more capital to grow in the next 2 years? If the US strategy is successful, would you need to invest faster?
Yeah, let me initially handle this, and I'll let Greg say what we can say. So yeah, according to our forecasts, you know, we're expecting break even at some point over the next 24 months. And we don't see our cash balance being a problem getting us to that point, as long as we maintain the twin focus on profitability and consistent growth rates. So we do have the option to accelerate spend to seize a growth opportunity, particularly if something reveals itself in, for example, the US. If that is compelling enough, then we can still make that decision. And we're still confident that our overall cash position will see us through to break even and therefore cash generation. But Greg, is there anything else you wanted to add to that?
I think you've largely covered it, Kit. What I would say is the guidance that's out for FY25 shows an EBITDA of 2.3 million. So that's a further improvement from the EBITDA we're reporting today. Would expect that sort of trend to continue. So as you say, we expect to break even in the next 2 years. And yeah, absolutely, we're confident that the cash position will be sufficient to that point.
Thank you. Could you provide an update on the ground in terms of your selling success in America?
I mean, yes, as we stand in the US, I mean, as you can see, it's now 26% of our ARR from a very, very small base 3 years ago. So we are being pretty consistent in our growth. The majority of our customers over here are still on the healthcare side of the industry. So that's blood plasma customers and a limited number of biopharma customers. The focus for this year is around augmenting that with effectively non-healthcare customers, with a focus particularly on food retail organizations and also facilities management players where we see a big footprint in the US. So I'm confident as I look at the year ahead that we'll be able to execute on that strategy and take advantage of the opportunities that present themselves.
Thank you, Now. Question on the data. How do you ensure that the data collected is correctly analysed?
Well, I suppose the short answer is, we have our own data lake. We have our own data scientists who are specialists in this field. One thing we're able to do, because of the vast amount of data we're getting from all our different customers, is to be able to compare and contrast trends and therefore, in a way, benchmark about what we expect to be able to happen and what we consider to be best in class. And that is then the job of the algorithms which they've built to make sure that data and the output of that data is effective for an organization. I mean, this is the reason why we've got customers going through quite a protracted and focused beta testing exercise in order to then firm up those algorithms and the effectiveness of them with customers. So it gets a feedback loop of its own.
Got a linked question to that is, are your customers being bombarded with actionable information created from various data generators? And if so, how do you overcome this?
I'm not convinced actually that the types of customer we are playing with are at the moment being overwhelmed with lots of data insight and intelligence. I think this has been quite an overlooked field in some respects. As it relates to their large operational footprint, there's not much that I can see of that's been giving them actionable insight such that they're then drowning, looking for signal in the noise. So at this stage, we think that when we speak to the customers, and this is universal both in Western Europe and also the US, when we raise the possibility of what we can do with our ML and AI tools, they are very, very excited because they've been crying out for this kind of actionable insight, and they've been getting none of it. So I would actually suggest that this is an underserved opportunity for our particular demographic, and one that we think we can really do a good job on.
We've got a compliment here and then a question. So the compliment: great job. ARR momentum is building nicely. And here's the question: you've both got a tranche of options due to vest in the next few days that are underwater, and it's a tough ask to your next set in a year. You roughly need the share price to double for them to be in the money. That must be slightly disappointing for you both, and I'm sure largely due to the broader market nervousness and misunderstanding of SaaS. So the question really is, are you both still up for this, and is the reward where it needs to be for you?
I mean, look, it's a nice compliment, and I understand the sentiment behind that question. Yeah, I mean, for me, this is a very exciting opportunity. I think the upside, if we can continue to execute on our plan, is significant. And I think once the market gets its head around the size of the opportunity, both in the UK and of course in the US as well, then I think we'll see that play through in the share price. So for me, I'm bullish.
Okay, thank you, Kit. Question about revenue and pricing. How should we view revenue price inflation? Is real price inflation on products possible for new customers? And can the existing customers' recurring revenue match or beat in period CPI?
I'll let Greg take this.
Yeah, sure. Thanks, Kit. So the short answer is yes. Real price inflation is absolutely possible. It's a competitive marketplace, so we have to manage our pricing against what's out there in the market and what people can get from other customers, other suppliers. But certainly as inflation has gone up and is now coming down, we'll be looking to make sure that our pricing reflects that.
Question again on the US. Can you give us a bit more flavour of the environment in the US and which areas are showing most interest?
Yeah, sure. So one of the high level differences that we see in the US compared to, say, UK, Western Europe, apart from the fact that it's this single joined up, much more expanded market, is they have a much greater number of what we typically call mid-tier customers. Mid-tier being, for CHECKIT at least $1 billion of revenues or more. They have a far more of these types of customers, which might have anywhere between 200 to 500 locations spread across the country. So where we see the interest and the appetite, we've been successful so far on the healthcare side. We have a lot more success that we should be expecting to drive there. Least of all, because actually we haven't targeted the US private hospital network that effectively so far, and that is a footprint we've developed well over in the UK, Western Europe. So we looking to transplant that success to the US. That's the first thing. Second thing, again, when we look at large facilities management providers, so think of names like CBRE or JLL with huge footprints across the US and their end customers as well. We see this as a great opportunity, given the stickiness of those customers that we have in Europe, and therefore the use case that we can put to play. So I think those are the opportunity areas where we see a good crossover of CHECKIT value prop, CHECKIT product market fit, and the ability to scale.
Thank you. Could you give some more colour on the inventory build-up, please? Is CHECKIT expecting high hardware cost inflation, so cheaper inventory was bought last year?
Yeah, so let me take that one. So I think it's important to remember the supply chain constraints that were in the market coming out of COVID. So actually the inventory that we bought last year was ordered about 2 years before that. So that was the level of supply chain constraint that we had in the market that meant that there were, an order cycle of 18 to 24 months, and certainly 24 months that it's worse. So we can, to a certain extent, talk with the benefit of hindsight now to say that the inventory we bought last year was at a lower cost than if we had have ordered it now. So we have benefited in that regard. It is using up some of our working capital at the moment, but that will unwind over the next 18 months or so. So yeah, I'm confident that has actually worked out in our favour.
Okay, and we come to the last question now, which is, are you looking to make any acquisitions to accelerate growth? And if so, what capabilities are you looking to acquire?
Yeah, it's a good question. So for us, we are softly considering M&A opportunities in the market. It's not a core part of our growth strategy. We want to do that organically. But where we would be looking at acquisition, I think, is where there's a complement to the product set, the existing product set, either on the workflow or the IoT sensor side, and one which brings with it a customer base that we'd feel confident in our ability to upsell, cross-sell in. Those would be the key characteristics. Geographic opportunity would be helpful. I suspect the US opportunities are a bit too highly valued, but we'll look at them as they come on an as-needed basis.
Okay, thank you, Kit. So that was the last question. Perhaps, Kit, you'll be able to summarise and say a few words before handing back to Alessandro.
Yeah, thanks. I mean, look, we're really pleased with the direction of travel. This is a tough economic climate, and so our ability to halve losses and continue to maintain consistent growth rates is exactly part of our plan. We're looking forward to taking people through more detail at the prelims in the back end of April, and indeed we're excited about the year that's now underway, and look forward to continuing on this strategy and seizing the opportunity further.
Perfect. Kit, Greg, Alex, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CHECKIT PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.